This video is a recap of the generational wealth building system presented during the Derenoncourt Dynasty Tour. Many of you saw this presentation live as I traveled with the Derenoncourts and spoke at your local BOM. Since the tour, dozens of people have asked me to send them copies of the presentation, so I've made this video available to everyone via YouTube. As always, I want to thank Tupac, Franz, and Leslie Derenoncourt for allowing me to travel with them and present this unique wealth building system to all of our 5 Links family. Before I begin, please allow me to reintroduce myself. My name is Corey Hankerson, and I work with the National Life Group, one of the country's oldest life insurance and wealth management firms. Our company, headquartered in Montpelier, Vermont, has offered wealth management and retirement advice since 1848. I have been a financial planner and tax advisor since 2005. I have also written 2 books on taxation and wealth management. My first book, entitled In the Tax Nightmare, Insider Secrets to Reduce Your Tax Debt and Beat the IRS, is available now. You can find In the Tax Nightmare at Amazon.com, Barnes & Noble, and Borders Books. The second book, Your Family Legacy, Expert Strategies to Build Multi-Generational Wealth, will be released in early 2013. I also hold a law degree from Northwestern University, where I studied estate planning and taxation. I also hold various state and federal licenses, all dealing with finance, taxation, and securities. During the Dynasty Tour, I was given the opportunity to travel all across the country, from Rhode Island to South Florida, helping spread the message of building your family legacy and how our wealth building system can help you build that multi-generational wealth. Before we can discuss the proper way to go about wealth building, we need to first understand why wealth matters. Building wealth matters because it is not just about you. It is about sowing a seed for future generations who come along after you. Michelle Obama said it best. When you've worked hard and done well and walked through that doorway of opportunity, you do not slam it shut behind you. You reach back and give others the same opportunity to succeed that you enjoyed yourself. And for those of us that read Scripture, we know that God intended for each of us to build enough wealth to leave behind for future generations. Proverbs 13:22 tells us that a good man leaves an inheritance for his children's children. But what is wealth? We are all here in 5 Links because we share a common belief. We all believe that 5 Links is a tremendous opportunity to earn life-changing income. But true wealth is not about what you make. It's about what you keep. In fact, many of the richest people in the world earn no income at all. Why is that? Because they have obtained income-producing assets, which earn income for them long after they have stopped getting up each morning, rushing off to work to trade their time for dollars. When you earn income-producing assets, you are truly wealthy, even if you aren't getting up and going to work each day. But the opposite is also true. The media is full of stories of individuals who have earned incredible incomes during their lifetime, but went broke just because the day that the income stopped. In 2009, Sports Illustrated published an article entitled, How and Why Athletes Go Broke. That article told us that 78% of NFL athletes are broke or bankrupt within 2 years of leaving the National Football League. How can this be? The minimum salary for a rookie entering the NFL is $310,000. The salary just increases from there. In the second year, the minimum is $460,000. So how would these players ever manage to run out of money? The answer is amazingly simple. No financial education and no income-producing assets. The result? The day they can no longer run a ball, catch a ball, or throw a ball, their income stops. Here's an example. Has anyone ever heard of Rocket Ismail? Rocket Ismail entered the NFL in the early 1990s. He made over $20 million playing professional football. He spent his money on lavish homes, vacation, failed businesses, and keeping his friends and family on his personal payroll to the tune of $60,000 a month. Rocket Ismail retired from the NFL in 2002 and was dead broke by 2006. But he's not alone. Deuce McAllister, bankruptcy in 2009. Mark Brunell lost his home to foreclosure in 2010. My personal favorite, Travis Henry. Travis Henry made over $60 million during his time in the NFL, but was thrown in jail in 2009 because he couldn't pay his child support. I don't put this information up here to make fun of these guys. I put this here to make the point. And the point is, it's not how much you earn, but how much you keep, save, and invest. When I sit down with a new client, I advise them to look for 4 important features when considering any investment. You should look for safety, liquidity, positive rate of return, and tax-free income. Any investment that lacks any of these four things is not a good place to invest my money, and it's not a good place to invest yours. But how do most Americans save and invest their hard-earned dollars? Most Americans store their primary wealth in three places. The first is bank products, such as CDs or money market accounts. The second is qualified retirement accounts, such as 401ks and IRAs. The third is home equity. I will show you that neither bank products, qualified plans, nor home equity are the best place to accumulate your family's wealth. Most people encounter IRA and 401k products via their workplace. The main problem with accumulating resources in these products is that they are not safe, and they are heavily taxed when you withdraw your money in your later years. I'm sure I don't have to convince you of the potential danger of investing your money in the stock market. Most of us are probably aware of the fact that millions of Americans saw their retirement accounts go from 401ks to 201ks during the Great Recession. The issue of taxation, however, is something that most Americans really don't understand. I don't have time to go into great detail here, but the point is that you will owe much more in taxes when you're ready to withdraw the money than you ever saved while you were contributing to that 401k or IRA. Many Americans also hold their wealth in the form of home equity. Home equity is not a safe place to store your wealth either. Home equity is what your home is worth minus the mortgage you have on the property. But what happens to your home when the local real estate market declines? In that environment, the home loses value, regardless of how nice your house might be. Home equity is also not liquid. If you lose your job, become disabled, or suffer damage to your credit rating, it becomes difficult, if not impossible, to access that home equity because banks only lend money to those who really don't need it. So when you need that money most, your banker may just deny your loan. Finally, equity also pays no rate of return. It doesn't matter where your home is or how nice it is, the rate of return on home equity is always the same. It's zero. You have more equity only because the house goes up in value or you paid down the mortgage, not because you earned any rate of return on the equity itself. Finally, bank products. The biggest problem with bank products such as CDs and money market accounts is that the rate of return on these products is too low to build real wealth. Rates right now are in the 1 to 2% range. At that rate, you would have to save every month for the rest of your life and still not accumulate any real wealth. Making matters worse, these accounts are fully taxable as they grow. So that 2% gain becomes really more like a 1% gain after you factor in the tax hit. So what is the best place to store wealth and build your family's legacy? Where can you find all of the investment attributes you need in one product? When most people come to me as a financial planner and tax advisor, they don't want or even need life insurance. What they want is liquidity, safety, a decent rate of return, and tax-free access to their money when they want it. After I show them several options, most of my clients do exactly what I do with my money. They choose a properly structured, investment-grade life insurance contract designed to provide them with safety, liquidity, rate of return, and tax-free access to their money when they need it. Many of my clients choose to pull money out of their IRA or 401k to invest in the indexed universal life insurance contract, or they may simply stop contributing to their IRA or 401k and invest in the life policy instead. Some will choose to invest in the indexed universal life contract by moving their money from home equity and into the IUL. Some simply decide to invest on a monthly basis from their checking or savings accounts. Regardless of how the product is funded, most of my clients feel that it is the best wealth creation tool they have ever seen and wish they had gotten involved sooner. Although most Americans do not view cash value life insurance as a tool for creating wealth and legacies, this concept has been around for over 100 years. In the 1950s, Walt Disney dreamed of opening an amusement park filled with great rides and great food. Everyone told him it couldn't be done, especially since he wanted to build the theme park in Orlando, Florida, which was mostly swampland at the time. He was turned down by bank after bank after bank, so he used the cash value in his own insurance policy to finance the project. Disneyland opened in 1955 and has been a tremendous success for over 50 years. In 1955, Ray Kroc opened the first McDonald's restaurant. He struggled with cash flow and needed additional funds to stay in business. Having already drained his savings account and borrowed all he could from friends and family, he turned to the cash value in his insurance policy to get the business off the ground. Today, McDonald's is a global icon with more than 25,000 stores worldwide. During the Great Depression, JCPenney stores almost went out of business. The only source of financing available to the company was the company's owner, James Cash Penney, and the life insurance policy that he held. He used the cash value in the policy to cover day-to-day costs of keeping the business open and to meet the company's payroll expenses. Finally, when Leland Stanford, the governor of California, lost his son to typhoid fever in 1868, he decided to honor his son's memory by opening Leland Stanford University, today known as Stanford University. To keep the struggling school open, the family used the cash value from a life insurance policy to help fund day-to-day operations and to pay the school's faculty. Let's take a look at how this wealth creation tool works in the lives of our typical client. What I want to do now is run through an example to demonstrate the way the product works to create multi-generational wealth. Meet Anthony and Michelle Cruz and their baby boy, Nathaniel. They're both 45 years old, in average health, and can afford to invest about $500 per month to build their family legacy. Anthony and Michelle are looking for solid, steady returns on their money, protection from market losses, and guaranteed income when they're ready to retire. They would also like to build a legacy to leave to their children once they're gone. To satisfy their needs, we put together 2 indexed universal life policies with a death benefit, which I call a legacy, of $300,000 for each spouse, which Michelle and Anthony plan to hand down to their children and grandchildren once they pass away. These indexed universal life policies offer them safety of principal, liquidity, an excellent rate of return, as well as tax-free access to their money in the form of a guaranteed income for life. The policy also offers valuable living benefits in the form of terminal illness, chronic illness, and critical illness riders. These riders provide coverage for the family in the event that they become injured, ill, involved in an accident, suffer a heart attack, stroke, diagnosis of cancer, etc. 1 year after the policy is issued, Nathaniel suffers a heart attack, but does not pass away. The family takes $65,000 out of his legacy, or face amount. Note, even though Anthony has only paid in about $6,000 into the policy, he is able to access the full $65,000 because he suffered a heart attack. With that $65,000, Anthony and Michelle pay some medical bills. They make a down payment on a new home, and because they see the value in the Indexed Universal Life policy, they invest $25,000 in an Indexed Universal Life policy for their son Nathaniel. When Nathaniel was ready to go off to college, Anthony and Michelle used the cash value in their policies to help fund his education. They access $5,000 per year for 4 years to cover the cost of meals, books, room and board, etc. At the age of 65, the couple is finally ready to retire. They have a combined cash value of $500,000. They are able to enjoy a guaranteed, tax-free income of $50,000 per year, every year for the rest of their lives. Now, the average American has less than $60,000 saved for retirement. This couple has nearly 10 times that amount. Additionally, their income will be paid to them on a tax-free basis. This means that their retirement dollars will go much farther for them and last much longer. 20 years into their retirement, Anthony is diagnosed with congestive heart failure and is said to have 2 years or less to live. Because he is diagnosed with a terminal illness, he can access a portion of his legacy while he is still alive. His legacy, or death benefit, has grown to over $65,000, and he elects to access $235,000, and with that money, he makes an outright gift of $150,000 in cash to his son Nathaniel. A few years later, Anthony and Michelle both pass away. The remaining legacy is now over $600,000. They make an outright gift of $500,000 to their grandson William and invest $130,000 into 2 policies, indexed universal life policies, for each of their 2 great-grandchildren. Let's take a look at Nathaniel's policy and how it has grown over the years. He has an indexed universal life insurance contract just like his parents. He has a $500,000 death benefit, or legacy, which he intends to leave for future generations of his family. You'll recall that Anthony and Michelle made a lump sum contribution to Nathaniel's indexed universal life contract when he was a child. They contributed $25,000 and just let it grow, with no further cash investments. By the time Nathaniel is 35 years old, he can start to receive an annual income of $35,000 completely tax-free. This $35,000 annual income will be paid to him every single year until he reaches the age of 65, where the annual tax-free income will increase to $200,000 per year for the remainder of his life. If he lives to reach age 100, Nathaniel will have received over $8 million in tax-free income, tax-free guaranteed income, no matter what happens with the stock market, no matter what his choices are in life. When Nathaniel passes away at age 100, his legacy will have grown to over $9 million. He will also have $8 million in cash value. When he passes away, those amounts are left for his children and his children's children, and the wealth cycle starts all over again. So let's look at the multi-generational benefit summary enjoyed by this family. During the course of their lifetimes, Michelle and Anthony received living benefits of more than $577,000. When they passed away, the legacy they left behind was over $1 million. Nathaniel received over $8 million in tax-free income during his lifetime alone. Finally, we have an exclusive offer just for our 5 Links business partners. If you are interested in learning more about the wealth building tool we have demonstrated today, simply reply to this email, enter your name and phone number, and we're going to contact you and schedule an opportunity for you to sit down with myself or one of my top advisors to see exactly how this product would work for you and your family. What you have just witnessed today is a generic overview of the Index Universal Life Insurance policy. Because the product is going to perform slightly differently for each and every family, we're actually going to sit down with you and walk you step by step through the cost, benefits, and performance of the product. There is no purchase obligation whatsoever. But just for sitting down with us, I'm going to give you a free Caribbean cruise vacation certificate, good for a 7-day and 7-night Caribbean cruise for 2 adults. All you have to pay is the taxes and port charges, and you're on your way to the sunny Caribbean. Again, there is no obligation to buy anything. But just for sitting down with us, I'm going to give you the free cruise certificate. We are only extending this limited time offer to our 5 Links business partners, and it's just to celebrate the Derenoncourt Dynasty Tour and to thank you for watching this presentation and considering our company's products. I want to wrap it up today by encouraging everyone to begin the process of building your family legacy. The key to becoming wealthy is not the level of your income, but the ownership of income-producing assets. Of all the possible asset choices, the Index Universal Life Contract is the only one that provides safety, liquidity, a good rate of return, and tax-free income for life, combined with living benefits to protect you in the case of serious illness, injury, or old age. I look forward to helping you all, and I wish you continued success in building your 5 Links business. Thank you for meeting with me. Have a good one.